Joining us with his take is JPMorgan Asset Management Chief Global Strategist David Kelly. Let's start with jobs. Weakest we've seen, I guess, in 4 years. What do you mean? What does that look like coming into the new year then?
Well, it is pretty weak. Of course, there are lots of gaps in the data and there are questions about the quality of the data, but the bottom line is highest unemployment rate in over 4 years and the lowest year-over-year wage growth in 4 years. And, one of the things we have very slow job growth, but I thought that the lack of labor supply might have held the unemployment rate down, held wages up. But it's, even that's getting a little weaker. So it's a pretty grinchy report, to be honest.
All right. So what does it portend?
Well, I don't think it actually portends that much. I used to call this economy a healthy tortoise. I think it's a little bit more of a sickly tortoise right now. But it is still moving forward. I think we'll avoid a recession. It'll be weak fourth quarter because early next year, we're going to get all these income tax refunds. I mean, this year, the average income tax refund was $3,200. Next year, we think it's going to be about $4,000. And that's all going to come in, late first quarter, early second quarter. And I think that helps push up consumer spending. So, I think the economy will rev up in the first half of next year and then, maybe fade again unless we have some further stimulus.
All right. So, GDP growth picks up in part because of consumer spending back by an additional $800 or so over the year previous. Why does the second half then get weaker?
Well, because first, you've got this level of consumer spending that you're now not going to be able to sustain because, this is sugar. It's not protein. People spend it, it's gone. And so it'll be hard to maintain that pace of spending in the second half. And then also we don't have much labor supply. I mean, it's, I think the native-born population, working age population is shrinking. So without, we've got almost zero net immigration, it's going to be really hard for this economy to grow by more than 1.5% at a trend rate. So we think, maybe 3% first half, 1% second half, and maybe if we avoid recession, 1.5% next year. But it's certainly no boom.
When you say avoid recession, I mean, the GDP growth looks actually quite good and quite strong, thanks to a lot of the investment that's happening around AI, the increased business investment. I mean, even as I mentioned, the retail sales numbers today were good as far as the control group that feeds into GDP. So that's not, it's really a labor market recession, not a recession.
Well, the GDP numbers will look better than the employment numbers, but I think even in the fourth quarter, GDP growth may be only in the order of 1%. So it's not exactly booming. I think it will be about 3% or 2.5% to 3% for the second quarter.
Third quarter.
For the third quarter. So I think it is slowing down, but even in investment spending, yes, there's a huge data center boom. But if you look at things like heavy truck sales, they're really weak. If you look at construction spending, home building, it's not strong. So we are seeing, I think there's so much focus on these data centers that we're kind of missing the point that a lot of other investment spending really isn't that powerful right now. And also in the energy patch, because we've got low oil prices, we're not seeing a lot of drilling.